appreciate the opportunity to moderate this panel today with so many great people, and we're going to have another one coming in here very shortly as well. I apologize to be coming to you with a little bit of a sports injury today, just in case there are any questions. Yes, it is a black eye from sports. It's not any nefarious reasons. So we'll kick it off here. Panel discussion about cash flow versus appreciation investing for passive investors out there. I'm going to ask the panel to introduce themselves individually. We've been through this. You guys know what's going on. And Maurice, I hope you can kick it off for us and tell us about your very impressive background and where you stand on this issue.
Yeah, well, it's definitely good to be here. Rama, Trevor, Taylor, Sayla, Arn, and I appreciate it. So my name is Maurice Filigene. From a real estate perspective, I'm one of the founders of Quattro Capital. That's my logo that way. There's 5 of us. I am born in New York, raised in Boston, live in DC, and ended up at University of Virginia, 25-year executive at a consulting firm, 22-year lieutenant colonel and federal agent in the military, and 15-year street cop in my own home county, if you will. And started Quattro Capital 2 years ago, and we've done about 130 million worth of assets and have another 40 or 50 under contract, so we're doing really well. Passive income versus equity, cash flow versus equity. The reason that I give my answer is because it just depends on people's goals. And I want to tell you just real quickly, I earned my financial freedom by buying single family homes from 2002 to 2014. I got up to 35 single family homes, ended up with 18 paid off. That was 160 grand of passive income a year in 2014, but I did not quit working because everybody has goals. What I wanted to do was secure my basic needs, how to pay the mortgage, how to eat. I did that. That was the goal at the time. Now my goals are around family legacy and philanthropy. I do an enormous amount of work in the Mideast, specifically Lebanon. So equity matters to me now because I need to build wealth, have large chunks of money, $100,000, $200,000, $500,000 to do what I do. So hopefully that gives you a little bit of background on who I am and where I stand on cash flow versus equity. It depends on your goals.
Love that. Love the focus on the goals. Next up, Mr. Trevor, are you with us? Yes, you are. Take it away. Tell us about yourself and where you stand.
Again, very excited to be here with such a distinguished panel. I'm actually originally from Niagara Falls, Canada. Spent my entire life in the attractions and entertainment field. Started passively investing 4.5 years ago. I'm an LP in 17 different syndications and switching to active a GP on my first one. For me, the most important thing is IRR. I want to know that my money is working for me, but I do love cash flow. So I like to get into deals that have a pref payment. If there's cash, I want to get mine first. And then after I get mine first, I'm okay for everybody else to get theirs. And I also love a deal that has a waterfall. I want the GP team to rake in the dough if I do is better. I want us all to do better, and I want to have our interests aligned, and I want them highly rewarded for beating the expectations.
Great, awesome. Well, Mr. Sayla, you are representing the Prax today, at least so far. I'm sure Eileen's going to join us here shortly. Tell us about yourself, please, sir, and where you stand.
Hi, everybody. My name is Sayla Pratt. I am a co-founder and Chief Operation Officer for Barnabas Capital. My wife and I, Eileen Pratt, we also hosting a 5-day-a-week podcast called How Did They Do It Real Estate Podcast. So our stand with passive investing, we started out as a passive investor and invested in 11 deals ourselves before we switching to active side, but we still continue investing as a passive investor. So for us, I agree with Maurice. It's more of what is your goal and what is your first step that you try to achieve in your life goals. For us, we're looking for deals that like providing cash flows, and because our goal is we want to make sure that we have our first step is to have enough cash flow to cover everything that we have in the expense and possibly extra. So that's why we're focusing more on cash flow at this point. And eventually, of course, we'll start looking at additional deals and taking some more risk, potentially of having additional upside on the deals in the future.
Great. Thanks so much. Now, Arn, you're up next. Tell us about yourself, where you stand, what you do right now.
Yeah, so I kind of like to be a contrarian. So I'm going to come down on the side of equity growth. But to back up a little bit, born and raised in Silicon Valley, sold residential real estate in Menlo Park and Palo Alto, California for years. About 7.5 years ago, moved to Greenville, South Carolina. And that's the world famous Liberty Bridge in the background. First and second round of March Madness is taking place in Greenville. So it's going to be a cool weekend. So longtime real estate broker and investor, moved into multifamily about 2 years ago. And I agree with the panelists that one size doesn't fit all, right? That we are all individuals, we have different goals, we have different needs. And so cash flow may not always be king. At the end of the day, the one with the largest nest egg is probably going to have the largest cash flow. I'm 67. I think I'm going to live another 25, 30 years. So I'm still trying to build equity and wealth. I have enough cash flow to cover my needs. And so that's kind of where I'm moving. So it'll be a great discussion. Looking forward to it.
Great. And now, Jeremy Roll, please take it away. Tell us about yourself and where you stand.
Yes, Taylor, thanks for moderating, and Rama, thanks for having me here. It's nice to see all the other panelists. So my name is Jeremy Roll, originally from Montreal, Canada. Lived half my life there and about half my life in the US, mostly in Los Angeles, but also in Philadelphia for a couple of years. I was on the typical corporate path. I spent over 10 years in the corporate world. Last two companies I worked for were large companies, Disney headquarters. Last one was Toyota headquarters. Having an MBA from the Wharton School. And then on the investing side, I started investing passively in syndications or managed or pooled opportunities in 2002 in real estate. And then the cash flow got me out of the corporate world in 2007. So I've been investing in these types of deals for 20 years, but full-time for 15. I also manage a group of over 1,500 investors who are looking for similar opportunities to me. And I'm honestly very cash flow focused. I've always been cash flow focused. Some of it has to do with my risk profile. You know, agreeing with pretty much everybody else here, it really depends on your goals. I do want to say that, like Sela, though, what I did was I created a base foundation, core foundation of cash flow over a period of time. And then when I had that in a good position, I started to get into more equity type of opportunities, some real estate, some non-real estate, honestly. And so, but that was only once I was really comfortable getting past having a big enough cash flow snowball, so to speak. But I always say there's 1,000 ways to invest. None of them are wrong. And it's really whatever is best for the individual. But I'm very heavily cash flow focused. And I will say that one of the things I really like about cash flow is that I feel like by earning the cash flow on the deals, that also has some potential upside. It's a little bit reduced risk versus just swinging for the fences on a pure equity play. So that again, it's just congruent with my personality being pretty low risk.
Nice, love it. And now Eileen has joined us. Eileen, it's now your turn we're going to throw you right into the water here, ask you to tell us about yourself and where you stand on this issue of cash flow versus equity growth or appreciation.
Hi, thanks so much, everyone. So I'm Eileen Prack. I'm the co-founder of Bonavest Capital. I'm an active investor and as well as a passive investor. I don't know if Sela mentioned, but we also host a 5-day-a-week podcast called How Did They Do It Real Estate, where we interview experts in the space in the real estate, sharing their journeys, sharing their experiences with everyone. And for us, I personally like to focus on cash flow with the potential of appreciation down the road. I always like to make sure and try to invest and mitigate as much of the risk as possible. And so that's why I like to look at cash flow first.
Great. Awesome. Well, there's a lot of directions that we could take this conversation, but I'd like to point out that a few of you have exited the corporate world permanently, and a few of you are still in the corporate world. And those of you that exited the corporate world, some did so deliberately and others just kind of happened due to changes in the economy, right? So those of you that have exited the corporate world, can you tell us how your investing played into that exit of corporate? Because that's probably what a lot of our audience is attempting to achieve through either cash flow or appreciation investing. Whoever wants to pick it up, or I can call on one of you if you want to.
I can pick it up.
Please.
I just left. October 31st, 2021 was my last day after 25 years at the same corporate consulting firm. I could have left in 2014. I think Jeremy talked about, I think it was Jeremy who talked about 2007.
Yes.
The role of cash flow, I love cash flow because it gives us life options, right? We live off of cash flow. We use cash flow to go to the movies. We use cash flow to go to the grocery store. We use cash flow to pay our bills. That's why it's so powerful. So let's say you never get the huge equity windfall, but you have 10 grand of cash flow that you've built up through passive investments over the years. You have more life options than probably 95% of the people on the planet, right? We live off cash flow. If you have 20 million in a bank and you're going to live off of it, eventually that 20 million is going to go to zero. If you're living off recurring revenue that's coming in from a source where your time is not involved in generating that revenue, not only do you have cash flow, you have time freedom, you have life options, you have the ability to go live as you were intended. So cash flow played a huge role in me leaving corporate. It gave me confidence to leave corporate. And now I don't even remember what corporate feels like. It's been 6 months now. Yeah, man, it is one of the easiest ways. It takes work, but it's one of the easiest ways to separate yourself from the rat race. And I think that's what a lot of people are trying to do.
Great. And Trevor, you are on the other side of the exit from the corporate world where COVID really kind of, well, forced your hand or foisted that upon you. Can you tell us about that experience and how your real estate investing played into that and helped you make it through?
So I was definitely more appreciation focused, and I had no intention of keeping any of the cash flow. The goal was to 100% reinvest it to be able to build the wealth quicker. And then, of course, I was looking over the episodes of this COVID event and I got let go. And I'm not going to lie, my life changed. And I now have been spending and living off of the passive income. So I'm certainly glad it's there. But I've tried not to let it switch my focus on that. I want to still create, I still need a bigger nest egg. So I'm going to call it living hungry and trying not to live off of that cash flow, trying to make smart investments that will increase my net worth.
Nice. Great. And Jeremy, you achieved the escape velocity from the corporate world in, I believe, 5 years, if I'm getting the timeline right. Can you tell us about that and whether you think that is achievable today through cash flow based on the deals that are out there in the market?
Yeah, that's a good question. So I don't want to take too much time on this, but just to be clarified, I didn't actually have a plan to leave the corporate world. I think that's important. So I actually left the corporate world because of a last straw moment with one of my managers. Okay. And my actual whole plan was after the .com crash, for anybody who remembers that back in 2001, I decided the stock market was the wrong, because of the volatility, the lack of predictability. That lack of predictability really bothered me, and it was the wrong fit for my long-term retirement account. So I started to rotate all my money from stocks and bonds into cash flow in 2002 for the purpose of keeping a paycheck and having cash flow, just for more predictable retirement type of funds for decades. But I ended up leaving because of the last straw moment, because enough cash flow was built up to live off of. And so one thing I want to point out is that I did not leave until I had at least a 2-to-1 coverage ratio of cash flow needed to live off of versus the actual cash flow that I had. And I think that's a very important point for anyone considering leaving. Even if you have a plan to actually get out, I would strongly recommend, fluctuations happen. Some opportunities have challenges. Depending on how many sources of cash flow you have, you may or may not be more exposed or less exposed. So I just want to throw that into the mix. It's a very important consideration to have enough cash flow coverage in a certain ratio, if you can do it, in order to be a little bit more less risky about it. So, and I'm sorry, Taylor, I want to get a few of those thoughts out, but what was your original question? I completely forgot.
So sure. Do you believe, based on the deals that are out there in the market today, can you achieve that escape velocity today?
Yeah, it's much harder today when I was starting out back then, because cap rates are much lower. And it means you have to deploy more capital to get the same level of cash flow, right? You have to have more capital to be able to invest to get the same level of cash flow I was able to get way back when. I also think that it's very important to consider timing right now, because We may be at the end of a cycle. So depending on what everyone's opinion is or your particular opinion, it may or may not be the right time to leave. If you're concerned that we may have a recession, are some of these cash flow sources are going to go away? I do think that in the 5-year timeline you mentioned that could be doable, but it all depends on how much money you have to invest. And then the other thing I'm going to throw in is that when I left the corporate world, I had a mix of what I call fully amortized and non-amortized opportunities. So just real quick, if you invest in an apartment building and you're getting X% cash flow each year, the interesting thing is you're getting cash flow, but you have equity in the actual asset that may be worth more at the end or the same amount or whatever, right? I call that non-amortized. You're getting cash flow, but you still have 100% ownership in the building or whatever your percentage is that, per rata share. I actually had a combination of stuff like that, but other things to supercharge my cash flow. And so I had stuff, I don't want to get into too much deep. I had some stuff that was paying me like, let's say 3-year leases on computer equipment where I was earning 50% cash on cash for 3 years plus a 5% buyout. And that's great, okay, because that's huge cash flow, but that goes away after 3 years. And now you've got nothing at that. You have no asset left because someone just leased that from you and bought it out. So you have to be very careful accelerating your cash flow through more fully amortized stuff. But if you get a balance of the two, you can actually achieve a goal in 5 years that might otherwise take 10 years, for example, or even longer. Of course, the risk is that you do not want to eat through your principal and end up living off of everything and going to zero, like Maurice said. So what I did was I then transitioned into much more non-amortized things over a certain number of years and was very careful with what I was doing. So I'm not a financial advisor or anything like that. I'm just sharing what I did. Be very careful if you're considering it, but it is one way to supercharge your cash flow if you want to accelerate a timeline or have not enough capital to invest to really get out for too long a time.
Great. Okay. And Eileen and Sayla, you're on the other side of that wall, if you will. Or I don't want to be too negative about it. You're both still in the corporate world, W-2 life, I suppose working to fund your investments. What are your thoughts about working actively to fund a passive investment strategy, especially cash flow focused, like I believe you guys are?
Yeah, so I think that, working our full-time jobs has been a great resource, has been a great tool to be able to get us to where we are today. We've been able to save up and be able to utilize that cash to deploy it into other assets, into other investment opportunities, where otherwise we might not have been able to do it if we didn't, have that good paying job, be able to save up to be able to do those types of things. So it's been a really very, very helpful tool for us. I think it has helped us to really accelerate our investing strategies, to be able to participate in a lot of these things where we might not have been able to otherwise. And so, yes, we are still working in our corporate jobs, but I think that combined with what we're doing on the investment side, we are, I think, working it on both ends to be able to supercharge it and to be able to get to our end goal faster, because now we're getting multiple sources of incomes and not just focusing on one.
So regarding that, sorry.
Yeah, and if I
let's go Sayla and then Arn.
Okay.
Chime in.
Yeah, I just want to add from our ends, we really love we both love our jobs and working as a at W-2, and but at the same time we want to have the option or a freedom of choice where we hitting a situation where we no longer have a job, and where are we going to get our cash flow to support our family. So that's why we start looking into additional investment. So I'm like an old style person. Before I discover real estate, or Eileen discovered real estate and brought me into it, I always looking side hustle, looking different ways to make more money for the family, looking for banks that pay additional interest and all the kind of stuff. At one point, I found a bank that actually paying 3.5% of interest, and that was about 4 years ago. And I was like, wow, this is amazing. And I started to put all our savings into this bank. And eventually, every 6 months, I would get a letter from the bank and say that the interest will keep going down, and keep going down, keep going down. And I don't have enough cash flows anymore to cover, like the mortgage or like our basic living, until I then discovered real estate syndication. That's how we get into it.
Nice. Arn.
Cash flow is great. I would submit to the audience that you need capital to create cash flow, right? And I think Maurice mentioned kind of 10,000 a month, 120,000 a year as being a reasonable goal to meet most people's living expenses. And so in my mind, the way I've always thought about it is if you have $2 million of cash that you can invest, you can get a 6% return on that, create $120,000 a year income, $10,000 a month income. So I would submit the capital often creates the cash flow that it's going to be harder to generate 10,000 a month income if you have $250,000 of cash to invest, which is why I kind of keep coming back to growing that nest egg, building the equity that then can be invested to produce the kind of cash flow you need. And in my mind, I've always kind of thought if you get to 2 million of investable assets, you pretty much have created financial freedom, not for a jet set lifestyle, but just for a nice upper middle income US lifestyle. 10,000 a month's a great target to shoot for. And if you have 2 million of investable cash, you can easily create that.
Absolutely. Well, if we have a few more years of 7 or 8% inflation, that 2 million might go up, but we'll touch on inflation here in a little bit. Now, regarding cash flow and excess cash flows, this is one of the questions that I have for Jeremy and Maurice in particular. When you create, say, round numbers, $100,000 in passive cash flow, and you're only spending $50,000 a year to maintain your lifestyle. Those are ridiculous numbers. They're way low, but I want to go with the 2-to-1 ratio. What do you do with the excess cash flow to keep it working, especially since it's not going to come in as a $50,000 chunk? It's going to be piece by piece, month by month, quarter by quarter. How do you keep that all working?
I call it storing it. I store it. I know my monthly numbers. My monthly numbers are around $6,000 to $7,000 what I live off of. I'm simple. I don't really need a lot at all. So I have a lot of excess cash flow that comes in. I don't save that money. I store that money. And I use the word store because it evokes a different mindset. It's the same thing that I think Eileen and Selah are doing, and why I appreciate what they said about working to supercharge their goals, because I had enough cash flow, but I still worked for the last 7 years when I could have left. I was taking all that excess money, putting it in a storage account, savings account, a storage account. And as soon as I had enough to go buy an asset passively or actively, I would go do it. That's what Arn is talking about. Just me saying that I had $160,000 of cash flow in 2014. It's true, but I had to generate a lot of paychecks to come up with that. And it was also at a time where you could get no doc loans and nobody was checking W-2s. And I took advantage of all that stuff. But the way we build for the future, I am going to lean the direction that Arn is leaning. Building mass amounts of equity puts you in a position to generate mass amounts of cash flow. I know that there are ways to generate cash flow from the beginning, but for long-term sustainable cash flow, you got to build a certain amount of equity. Even our passive investors at Quattro Capital, when they come, we sit down with them, we look at how many times they need to put their money into a deal for it to go full cycle. It's usually 2.5 to 3.5 times full cycle, depending on $100,000 to $300,000 invested. If they can do that, and we can continue to have the performance we're having, you can probably grow that to 800 grand fairly simply, and then convert that 800 grand into cash flow the way Arn and others were talking about. So I invest my excess cash flow. I rarely use it.
Yeah, Taylor, just to add to that, I'm the same way. Like essentially, especially with inflation right now, the last thing you want to do is have money sitting around and not working for you, right? And the way that you have a cash flow snowball and actually make it grow over time is to redeploy the capital as efficiently, as quickly as you can. Now, I'm not saying don't go out there and just invest in the first thing you find. That's definitely the wrong thing to do. But redeploying is the number one challenge that someone who's doing this has, because it's absolutely critical. And I also want to say that, you know, what's coming to mind as well is like, not necessarily multifamily, but there are some other opportunities, some non-real estate, where you can end up getting pretty high cash on cash returns, so that your return of capital can be, especially with some tax benefits, as quick as a year and a half, or 2 years. And now what you're doing is you're compounding. And if anyone who's listening to this hasn't ever really gone on a spreadsheet and looked at the power of compounding, I would strongly urge you to. It's unbelievable, especially if you take it over a 5 or 10 year period. And especially if you're compounding back into high returns again. And so I've had the fortune of being able to do that actually in those equipment leases I mentioned that I rattled through that example. I probably end up issuing about 80 or 85 leases at a 50% cash on cash return for 3 years and a 5% buyout, which is actually a 28% interest rate on a financial calculator. You compound that over 8 years into 80 leases, and you end up with Arn's holding one up there. So you basically end up with a much larger stack of equity than you had to begin with. So there are some strategic ways to grow your equity, even via cash flow investments, right? Which is kind of interesting to consider and a different topic we discuss. I just want to point that out because now I have a mix of, I'm just I'm in over 60 things. So, and I've been doing this for so long that it kind of adds up, right? So it's not really a fair comparison, but some of the stuff I do is that for the compounding, right? Just to get more diversification and get some of the compounding and let that work for me as well. So there's a lot more we can discuss on the cash flow side, but I want to point out that's another way to build equity. But I do agree with everyone, building the equity is absolutely key. There's kind of no way, there are some ways around it, but they're challenging. You can wholesale homes, you could do certain things, you could do buy owner financing, no money down, you could do all these things, but they're very challenging to do and you have to be very specialized to be able to do them.
Totally. Now, Trevor, you're the one you hit us with some facts and figures or some numbers like IRR and all those types of things. And I want to ask you, splits of different share classes have become more popular in the last few years. Specifically, there are a lot of deals that'll do for passive investors, preferred return only or preferred return plus upside. The preferred return only is usually a little bit higher than the preferred return plus upside, but that upside potential gives you upside potential. So where do you stand on those two issues? Which way do you prefer to go and why?
Yes. So my IRA money, I do just like a straight preferred return. I like to be safe there, take that safe. And then on my cash money, I like to have the smaller return with my portion of the upside. And that's how I split up what I do.
Absolutely. Go ahead, Arn.
And if I could second that, so all the deals I'm in as a limited partner, I've always invested in the Class B shares because I do want some of that upside. I don't want to be a lender. If you really look at it, your Class A limited partner investor is strictly a lender. I don't want to lend money. I kind of want to own property and benefit in the potential upside. So everything I've ever done has been in the Class B shares. So that's how I do it.
I just want to challenge Arn for a second. I know he's like a big challenging guy. So Arn, I've been in some pretty interesting preferred equity deals. Now, this is not the normal, but I want to point out just an example of one. So I was in a deal that was basically someone had purchased a property through a syndication. They had after 5 years, had the right to buy out their investors at a predetermined amount. It was way below base. It was actually 2009 acquisition in 2014, big multifamily like property, Class B, multi-hundred units. But they weren't allowed to flip the property for a year. So what they did is they used bridge money to buy out their investors for a year through preferred equity. I made 14% preferred equity on an effective 45% loan to value while I bridged that until they got us out and actually sold the property. So I actually want to point out, I completely agree. I don't like doing pref equity myself because you don't capture the upside. So I'm very specific about it for you, but you should keep your eye out for unique ones because sometimes they're out there. Sometimes it's compelling enough. I just want to point that out.
And Jeremy, you're a lot smarter than me about all of this. And so I totally get it that there are a lot of cool ways to do it. I was just kind of speaking in general. I think I just like the Class B.
Yeah.
I understand. Yeah.
I
understand.
I just want to make sure the listeners also keep an eye out for unique deals because they actually exist on the cash flow and on the equity side all over the place. They're very hard to find. And but just look out for those two at any timing, even in bad timing, good timing, because there's interesting stuff out there.
And do it with somebody you trust and you're sure, right? Some of these big deals, you got to be very careful, Again, make sure that you're well leveraged and well secured. And again, you can do really well. I've got one at 16%. It's not bad money. I'm okay with that because that's my IRR goal anyways.
Nice, nice. So Eileen and Selah, we have a unique combination right here. Spouses that are business partners, and a lot of our listeners probably have a spouse that may or may not be on board with real estate investing, but I'd like to dig into the dynamic of investing and doing business with your spouse, and how do you handle delegating responsibilities, working together, working synergistically, and also handling, disagreements, because it's going to happen, right?
So it's all about the communication, and I won't lie, it's been a learning experience, communicating together as a spouse versus communicating together as business partners. But it's all about communication and being open and understanding what the ultimate end goal is, because we are operating together as a unit, as a couple. We're doing things together, so our visions, our goals have to very align closely to each other. So we always have to have that open conversation and constantly communicate with each other, whether or not we have our disagreements. And then what has really helped us, especially as spouse, is telling each other when we are talking to each other as a business partner versus a spouse. So we do this thing where I always say, okay, now I'm wearing my wife hat, or now I'm wearing my business hat. And so that way you put yourself in that frame of mind to understand the different points of views at that specific point in time. What kind of goals are we trying to achieve? And that has been really helpful for us as we are communicating. Of course, it's a continuing learning experience, and we're always evolving and adjusting. But I think the main thing is just being open and being vulnerable with each other, and just communicating constantly. More communication is better than less communication, especially with your spouse and your business partner.
And of course, on top of that, in terms of the business partner itself, try to have a role and responsibilities, and like split out and who's doing what. And if someone needs help, of course, we'll communicate with each other and say, oh, I need help on the underwriting, I need help on talking to an investor or something like that. Then we can communicate with each other behind the scene, but have a clear defined role and responsibility between your spouse. That would be a great help.
And Taylor, if I could just share with the audience, Selah and Eileen have two very young children at home, and they managed to do the investing, the W-2, and be parents to two small kids. So it's amazing how much you guys do. So props to you.
Thank you, Aaron.
Thank you, Aaron.
That's great. So Maurice, I heard you talk on a podcast a little while ago about your experience during the Great Recession and how the economic fallout impacted the cash flows of your then single family rentals. Can you tell us about that and the lessons? Sorry to bring up.
You brought up some mental scars for this.
Sorry,
boy. So what Taylor, what you're referencing is I said that I bought a lot of single families in the 2000s, and I feel like I got up to 35. It might have been more. I was young, like really young. And I'm one of those guys who doesn't overanalyze. I don't get paralysis. I just course correct along the way. So I just jumped in. And when 2008, 2009, 2010 came around, a lot of my tenancy just stopped paying because of the financial downturn. This is where multifamily is really powerful, because if you have a single family residence and someone stops paying, you got 100% vacancy, and it hurt. So in my case, probably about half of my tenancy stopped paying. I had to at that time, maybe I was 28, 29. I had about 100 grand in reserves, not by design, I just had it. So I was able to bridge the gap only for a short while, and then I just didn't have any money left. So rather than file bankruptcy, you know what I did? I was so incessant on keeping my assets that I called all 20 plus banking institutions, negotiated every single loan, negotiated a couple of short sales, negotiated a couple of loan modifications, and I made my way through that period. And that's when I became a police officer in 2008. So I was working full-time as an exec during the day, full-time as a cop at night, for about 6 years straight. And it was through that period. So that extra salary helped, but this is why multifamily matters. This is why economies of scale matters. if you have a 200 unit building and 2 families stop paying, you've got 198 other families that are still sending revenue to the bottom line, right? But yeah, man, that was a very, very challenging time period. And that's also probably why I was so bullish on paying the rest of my portfolio off. I never wanted to feel that again. The conventional wisdom will say, why would you keep all that equity within that portfolio? Why? Because I still have them. And my response is because it's all based on goals. My goal at the time was securing my basic life needs. It wasn't about money, it was about life. And I secured that. So that's what that was, man. That was a very, very rough time. But all it has done is inform me and my partners on what this current cycle is going to potentially look like. I know what cycles feel like now. So I can sense that we're in one right now. And but I made it through, but it was a tough one.
Wow. Well, I appreciate you sharing that. And that gets to a point that I wanted to bring up and kind of toss up there. I can call on somebody if you want. I'm sure you're all going to have thoughts about that. But for the cash flow investors out there right now, are people really investing for cash flow today in the deals that are out there today with cap rates where they are and interest rates going up? Or is it all just kind of spreadsheet magic? I can call on somebody, or does somebody want to grab that ball? I know one of you guys has thoughts about that.
Well, if I could just jump in. So I started investing in real estate in 1978 when I got into the business at the age of 23. And I just looked up when Microsoft Excel was formed. It was 1987. So it is possible to invest without a spreadsheet. So I'll just leave it at that. But I just thought that was an interesting little factoid.
We do have some cash flow investors, Taylor. Like we on some of our deals, we'll have a 10% preferred, no upside, and probably 10% of the investor pool for a particular deal will take that 10% cash flow because they're living off of it and they want it preferred. And that, depending on where they are in life, in their mid 70s, one gentleman sticks out, he's in his 80s. He just wants the money. But in general, people understand that, look, we can find Quattro Capital. We're very good at finding deals in the 25 million range and anticipate disposing them around 40, 41 million. So they can get a huge upside. And now, because of the inflationary period, the materials to do the renovations, it's much higher. Our cash flow revenues are a bit lower. You got to accept that at the moment. You want the property to be healthy, and you want the property to have a hedge against inflation, this war that may or may not impact the world, the US government printing dollars at a rate that makes absolutely no sense. So you should expect less cash flow nowadays and go for the more upside. But people are still doing it for cash flow as well.
Taylor, can I jump in?
Please go for it.
Before I even answer, I just want to go back to Arn and say, Arn, I didn't mean to attack you before. I just want to make sure that's clear. I'm not that guy.
No, I know that. No offense taken. I enjoy a good debate. So
yeah, I wasn't even debating. It was more I wanted the audience to hear that there are some unique situations, because normally unlike you, I don't invest in pref equity. So Taylor, what I would say is that, look, if you take a look at me, I'm a bit of an extreme example because I was worried about cap rates and cash flow at the end of 2016. And that's when I actually stopped doing market rate deals in 2016. And frankly, without the pandemic, we would have had a recession in 2020 based off the yield curve inversion. So we were already there almost. So now we've been dragged out by all the money printing and stuff. But the reason why I mention this is because there are unique opportunities out there, and sometimes you have to pivot and or look at unique opportunities. So I 100% agree with you that cash flow deals, in my opinion, really kind of went away and were replaced by value add only deals, because I think the sponsors realized they couldn't really have the returns that investors would want to make the marketing packages attractive enough to find investors, probably as of about 2018, 19 plus or minus, right? And so I could be off by a year. And so as a cash flow investor that I am, and I don't do value add at the end of a cycle, I'll look at the beginning of a cycle, but not the end of a cycle, and then we can get into that separately. But I've been looking for unique opportunities only, and some are out there. I can give you examples if you want. I don't want to take too much time, but I mean, I'm investing in a Class A property right now in Houston, a 2-property portfolio with a tax abatement structure that's being converted to tax abatement. And by the time you're going into that deal, rather than the purchase cap at 334, you're actually in place cash flow is cap rate is 5.59. So I'm getting 8% cash flow year one on a Class A 2013 to 2015 true Class A buildings, but a unique structure, right? So my point is that you kind of have to pivot as an investor right now to find unique deals, but they are out there. They're just very hard to find. At the same time, I don't really believe that investing for cash flow today is the greatest idea, because when you do that, you typically don't have very much padding in your deal. And I certainly don't want to invest in an asset we might be heading into asset price changes if I've got no padding, no value add component, right? Which I think is what you're referring to. But I do want to point out that there actually are some deals out there that you can find, but they're just really hard to find.
Nice. Great.
Yeah, if I can add also, it's you got to take a look at the risks and opportunities that are out there. It's and what are some of the different opportunities out there? Because you can either have your cash sitting around and it's just losing money every day to the inflation, or you can invest in something that may have a potential, like a smaller upside, or it's at least hedging against inflation. But it's like, what are you going to be doing to hedge against that? And so it's just looking for opportunities out there to hedge against that, and so that your money is working for you and not just losing every single day, and just keeping your eyes out for what's out there.
Yeah, Taylor, I just want to add as well, just another really quick, easy example for everyone to hear is I'm about to invest in a buy and hold fund, 30-year fund with fixed rate mortgages, pretty reasonable loan to values, maybe 75%. And with the leverage, we're buying those houses at 8 caps. With the leverage, we're in double digits return year one, and those are long-term holds, right? And so because that's an easier thing to understand for, I think, people than what I was mentioning before. And just another example, like those are hard to find. It's very hard to find the 8 caps for houses, but some of those types of deals are out there. So there is stuff out there. You just have to be very careful and very picky.
Probably not sitting on LoopNet. Now I want to break into the people aspect of this, especially from the passive investing angle. People want to know how to vet sponsors that they're working with. And Trevor, I believe you mentioned that a little bit earlier. So I'm going to toss that to you first, and obviously anybody else can pick it up. But how do you vet your business partners or the folks that you're considering investing with?
Yeah, you got to be very careful. There's a lot of flashy people out there that look really good on the internet, and it's getting harder and harder. And I'm a new syndicator, so it's terrible for me to say look for somebody with experience, because now I'm telling you not to invest with me. But there is some advantages of new and hungry and willing to do anything and to take less out of a deal than there are some of the established people that are taking 4% acquisition fees, lots of things. When you start seeing deals out there, it's a new build and you get cash flow day one, those stuff, they're just giving you your own money back. So you got to be very careful on the who, and pick somebody that supports, first of all, your goals, but even more important, your values. People that really want to create a nice place for people to live, that kind of things. Look for people that you value their values, think the same, believe the same. It's very important. Very important.
Great. Now, I imagine Eileen and Selah, you guys, you obviously working together, each other, very, very well. But I imagine you're also investing with other business partners. Do you ever come to a point where one of you is interested in working with somebody in some way and the other just has suspicions about it? Has that ever happened? I imagine, Eileen, you have the woman's intuition. You might have that happen a little bit more often. What do you think?
There's some times where it's like, well, let's get into this a little bit cautiously, or let's pass on this one deal first while we evaluate and see how the sponsor operates and communicates. So maybe we'll sign up for their newsletter, or we'll sign up for other types of communication with them. We'll build up a stronger relationship first if we come to that type of disagreement. And then later on, when another opportunity comes around, because there always will be another opportunity around the corner, if we pass on this one, then we can evaluate it again if we've built a strong enough relationship with the sponsor. Because really, anybody can put in numbers into a spreadsheet, make it look pretty, dazzle it up, put all these gems onto it, but you're not really looking at the deal itself. When you're investing with the sponsor, the operator. And so that's who you are really vested. That's who you're really vetting. And that's what you should really look at is is the sponsor somebody that you really believe can execute on your business plan and can take your money far for you? And they're going to treat it, not just like their own money, but like their grandmother's money. You want to make sure that they're going to be taking well care of it, because it's very difficult to find that type of capital to invest in those types of deals for somebody to just lose it away for you. And so really just vetting the sponsor themselves and looking at them and looking at their capabilities and their background, and exactly what Trevor had said, making sure that their goals and values align. But what's also really important too is the communication and the transparency that's really important for us.
Yeah, I just want to add the communication factor is very important, and especially you wanted to know the good and the bad news from the companies, and what has they gone through, what was the bad news that they can share with you, and see how they come out about talking about those bad news. And for me, like sometimes I would go out to meet with the operators, have lunch or dinner with the operators, get to know, and sometimes meet their friends and family just to get to know them as well. And that's very important, that you have to know, like, and trust the operator.
And Taylor, if I could just jump in, I think as a passive investor, you don't need to go all in on one deal. So I would encourage people to, if they have a certain pool of money they want to invest in, say, multifamily syndications, divvy that money up maybe into 3 or 4 little packets and make 3 or 4 investments with several operators, because I'd submit at the end of the day, it's the performance that counts. It's not what I would call, and maybe harken back to Trevor, the dog and pony show where people promise the moon. So I think as a passive investor, as you get started in this passive investing, spread your investments around and then just see how each operator works. And I guarantee you will find 2 or 3 operators that you love. They communicate well, they find good deals, they operate the property properly, they exceed expectations. And once you find 2 or 3 operators you really like, you can just rinse and repeat that over time. You've kind of done your homework. You found people that you trust and do a good job. So I would say just spread it around, test the waters a little bit, find 2 or 3 people you like.
Great. Now we have 2 Q&As that I want to get to, but I have to first throw it to Jeremy. Jeremy, I think you said earlier you're in 60 as in 60 deals. I imagine that's not 60 sponsors, but that's a lot of people and opportunities to vet. So how do you handle that? And then we'll get right to our Q&A.
Yeah, I'm in over 60 LLCs. I don't recommend it. It happens over time. I do it full time, so I'm looking at all kinds of opportunities all the time. I just, in some ways, I guess I'm over diversified, but I love the diversification. It's I have a spreadsheet to track everything. It's really not fancy, to be honest. It's very basic. But if you're doing it full time, it's not as bad as it sounds, because frankly, to be honest, like, you're just checking to make sure that either monthly or quarterly cash flow is coming in when it's supposed to, which you can already kind of pre-populate a spreadsheet as to when it's supposed to come in each month, going 10 years out if you want. And then I really only bother following up on anything that's outside of about 20-25% variance compared to what the cash flow projection was supposed to be. And so, of course, like, I don't expect projections to be perfect. They never really are. But actually, if something's even above 25 or 20% above what it's supposed to be, I want to understand what's going on. And if it's below, I also want to understand what's going on clearly, right? And I'll focus more on those. But I want to understand both sides. But if you're doing a full time, if you're a kind of a lower risk passive cash flow investor like me, I invest in stuff that's usually about 80 to 100% occupied and it's stabilized. You're not going to be dealing with that many things at once, because you're starting from a place of high occupancy already, and unless it's completely mismanaged, you typically are going to get some level of performance. So it's not as bad to track as it sounds.
Nice. Great. Well, I want to get to our 2 Q&A questions here. First one from Amir. How does one move from a wealth building strategy to a cash flow strategy in the most tax efficient manner, especially if one is still in the corporate world to minimize taxes? Now, before anybody answers, I'm going to say, talk to your CPA. That's the thing to do. But I want to let anybody comment on that, about how you specifically have handled your own situation there. If anybody wants to pick that up.
So let me just say that without coming in too much detail, that one important thing to remember is if you're working, and I'm not an accountant, but I believe you can only offset passive income with or passive losses with passive income. I don't believe you can actually offset your passive losses against your active income, with some exceptions. And you have to be a full-time real estate investor, like all these different designations. But the bottom line is that that's important to understand. And so from a tax planning perspective, you're going to continue to be in the corporate world and having a W-2 or having a job, and you're going to have the investing, then you want to keep in mind that you have to set yourself up from an efficiency perspective to be able to offset the passive with the passive. And you can do that to an extent in investing in certain things that have some bonus depreciation, accelerated depreciation, et cetera. But as Taylor mentioned, I'm certainly not an accountant, so I don't want to get too much into the detail.
Great. Well, I'll just say, talk to your CPA, dig into it, and get specific advice for your situation from a professional who can, dig into your finances. Next up, what is a good resource to find a reputable syndicator for a new investor? If you don't know where they are, where can you go track them down? So I guess I'd maybe ask how you guys got started finding syndicators.
There's definitely no book with the good and the bad guys pictures in a mud book, So I wish there was, but to be honest, it is all about relationships, right? Connecting, going to networking events, meeting people, reaching out to people, and just saying, what was your experience like? There's nothing that is going to beat the human interaction with your sponsor to get the feeling, is this the correct relationship and investment for me? You can't beat it. There's no.
Yeah, and I'll add, my first multifamily deal was a passive investment. I invested $100,000 in somebody else's deal. It sold in 18 months. The market skyrocketed. That 100 turned to 230. I was very happy about that. But what mattered more was learning the process and learning about the person. The way that I found that particular syndicator, I was at a conference. He's former Air Force like me, and I could tell his value system, the way that Trevor was talking about. That's important. You want to find people? I think the best resources today is conferences and LinkedIn. You can get on LinkedIn and search a hashtag, passive income, passive investing, real estate investing. Find people who are syndicators. Listen to what they say. Watch what they say. Watch how they behave there. And then go to their website or find them at conferences just like this, so you can understand their value system and what they're about. And I don't know who said it, but I'm going to echo it. You are not investing in the property as much as you're investing in the operators who run it. And if your operators don't have a focus on people, or all they talk about money, all they talk about is money, I would run for the hills, because money is fleeting. You shouldn't chase it. They should be doing good by the residents, improving their quality of life, good by you as an investor, helping you achieve your goals. And then, okay, we're going to make a lot of money as a result of having those good intentions. Find the people who think that way, and now you've got a good foundation by which you could potentially partner.
And Taylor, if I could jump in, I started like Maurice as a LP investor and did 4 or 5 and then moved to the active side. And for me, podcasts were a great resource. Because one, you're learning about multifamily investing, and you're listening to people who are doing multifamily investing. And so, as Maurice says, you can kind of get a sense of who this person is and whether what he or she is saying kind of makes sense to you. Is there an element of trust, gut instinct? So for me, I've made most of my contacts listening to podcasts or doing podcasts, because when you hear somebody speak for 30, 45 minutes about what they're doing in the industry, I think you learn a lot about them. So for me, I would recommend the Clue in a podcast. You educate yourself and you get a glimpse into who these individuals are.
Yeah. And I would echo that also, because me and Sela are very similar to Maurice and Arn and everybody on this panel. Well, we started off as passive investors ourselves too. And so the way we found ours was also through the podcast, and then just really listening to them, because you feel like you almost know them in a sense. You're spending, like Arn was saying, 30, 40 minutes every single day just listening to that podcast. And so you really feel like you have an established relationship with them. And so for us, that has been really powerful. And then also you realize too, when you're in this multifamily space, especially, the network is not very large. So as you meet other people, you're going to hear very similar names being tossed around. You're going to hear the same circle of people. Everybody will know everybody else. And so it's very uncommon that you'll talk about someone or you'll ask about somebody's track record or how they are as people and trying to get some due diligence about them that somebody else might not know about them. And so it's a small community. Everybody knows somebody.
It's and I wish my first investment was like Maurice. My first 2 passive investments went full cycle and I made 0 money.
Wow.
And the hottest real estate market in Texas.
Oh my goodness.
But I'm still here and I learned a lot about what not to do.
Absolutely. A lot of great information in there, a lot of great ways to connect with people and then build long-term relationships. Next question from Gurjeet: how to go about investing in Class B shares and syndications. Arn, you said you target Class B shares and syndications. Jeremy, I believe you echoed that as well, but that's largely getting invested into a syndication is what's being driven at there.
And I want to point out that the term Class B doesn't really tell you much because, for anyone who is not familiar with it, you can have 20 classes of shares in an LLC if you want to, right? And so it all depends on what the manager, the sponsor is actually labeling them as. So, Arn, when you referred to Class B before, was that preferred equity or common equity?
No, so when I say Class B, that would be a Class A and Class B limited partner structure. So Class A would be the preferred return, no share of the equity. Class B would be the 70-30 split with a preferred return. And then in that case, generally the general partner would be referred to as Class C, right? Where in a deal where there's only one class of LP shares, typically the GP is going to be defined as the Class B member. So Jeremy, good point. It's not A, B, or C. Just look for the equity split with this lower preferred return versus a higher preferred return with no share of the upside.
Great. Well, you guys, by my clock, we are pretty much at the end. If anybody has any parting comments or things you didn't say, I just want to leave it open for you out there, but really appreciate the opportunity to moderate such a great panel. I want to thank everybody who tuned in and listened, and hopefully you got some great information out of this panel. I know I did. And Rama, I'll hand it back to you.
Did a great job as always, Taylor.
Thanks, Arn.
Great job, Taylor.
That's awesome.
Thanks,
Great job, Taylor. Yeah.
Thank you.
And thank you all. Great conversation around cash flow versus appreciation. Yeah. Thank you. Thank you all.
Awesome.
Thank you for having us.
All right. Thank you.
Thank you.
Have a good night.
Nice meeting everyone.
Thank
Bye-bye.
you. Thank you all. Thank you. Thanks for participation.